Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada, and I'm on a mission to become Google Map for hardworking Canadians seeking financial freedom. Today, I have a special guest here with me, Michael Kennedy, who is a lawyer, a Canadian-born American lawyer with over 20 years of experience. The reason why I have him is a little bit selfish because I just purchased a property last year in the States. And conveniently, I have some questions for Michael. And that's why he's here with us, sharing with us all the, I guess, nitty gritty legal concept that us Canadian folks have to pay attention to when we invest in the US. Whether you're having a business or whether you're just buying properties like me in the US, this is a video that you don't want to miss. But before I get started, make sure you give us a thumbs up if you like our video and find it useful. Welcome, Michael.
Hi, Cherry. Thank you for having me.
Yeah, let us know a little bit about your background because I know that you've gone to multiple schools and you're licensed everywhere, as far as I can tell.
Yeah. Okay. Thanks. Yeah. So, I guess I was born and raised in Windsor, Ontario. I got my law degree from Western New England College in Massachusetts. Went on to get my LLM in taxation from Georgetown University in Washington D.C. Then I spent
Oh,
a couple of years practicing law in California. I practiced in Detroit, Michigan for a couple of years. I practiced in Miami, Florida for a couple of years. And then I guess about 14 years now, about 13, 14 years ago, I set up my own practice here in Windsor, Ontario to cater
mm,
to Canadians with US legal issues. And so I am a foreign legal consultant in Ontario. I'm licensed to practice law in Michigan, California, Florida, and Arizona. I and I cater to Canadians, you know, uh, generally to wanting to do business or invest in the U.S. I help them
mhm.
with their structures, the U.S. structures, how they should be structured in the U.S. I help them obtain, visas, work authorization in the U.S. if they need that, and then just, help them, run their businesses in the U.S. or help them with their investments in the U.S. So I handle all their kind of like a, you know, all-in-one legal solution for Canadians in the US.
That's
Yeah.
quite niche that you have,
It
quite a niche that you have.
it is, yeah.
So, depending on how you look at the whole President Trump situation, the sentiment in the marketplace is that we are not buying any US. Now, let's say we are like that's one side of the story. Of course, the other side of the story is that well, this is a time to buy in the US because you want to earn some US dollars because inflation is coming. So, it really depends on what side you're on. Now let's just assume that you're on the side that you believe that we need to invest in the US. Tell us, investors like me, come to you. What's your go-to advice when it comes down to Canadian planning to buy in the US?
Well, I think the first once they made the decision to purchase, invest in the US is how do I buy? How do I own the real estate? How do I own the real estate, right? That's the key.
Yep.
And I mean there's a number of options. US has more options than Canadian as far as structures go. So,
Hmm.
but we also have to take into account, obviously liability protection. That's, first and foremost. And I think that's why people are looking at a structure is how do I protect my other assets if this goes
Yeah.
south, right?
Yeah.
But then there's the, oh, how does it affect me from a tax perspective, right? So
Hmm.
when we're dealing with cross-border, I mean, even not cross-border, when we're dealing with setting up a structure, we're always thinking about liability protection and what are the tax consequences. And I think in a cross-border structure, the tax ramifications are heightened. Like it's like, because you got two jurisdictions you're dealing with. So we start out with, hey, what structure, and we're talking about real estate. I mean, the options are, I mean, we don't want to own it individually. There's no liability protection, right? I mean,
Hmm.
so if that's off the table, then okay, we can set up a corporation in the US. Um,
Hmm.
and that's great, got liability protection. But corporations in the US are taxed a little differently than how we're taxed in Canada. So usually you're going to pay more tax through a corporation in the US and
Hmm.
particularly for real estate investments. But it's an option, and then some clients do go with that because it's simple. They understand them, they're familiar with them, from using them in Canada for their investments. Um, and then they'll just deal with whatever Canadian filings that have to be made with that. Usually the I don't say an ideal structure, but the typical structure is the limited partnership.
Yep.
Limited partnership. I mean, they are in Canada as well, so they are the same. And the important thing about the limited partnership, it's treated the same in both countries. So in cross-border taxation, that's what we look for first. Are we treated the same in both countries? Because if we're treated differently, you end up with double tax. And that dovetails me into the LLC, the limited liability company, which I know is
Mhm.
all over the internet. Everybody comes to me saying, I need an LLC. I'm like,
Yep.
well, let's talk about that. An LLC is a wonderful vehicle if you're an American resident. But if you're non-resident, particularly a Canadian resident, you're gonna end up there's a double tax concern there because the LLC is treated one way in the US and a different way in Canada, and you end up paying double tax over the course of the investment. So we tend to shy away from LLCs, at least where a Canadian owns it directly. So we go into the limited partnership. Limited partnership from a tax standpoint in the US is the same as an LLC. So from a tax standpoint, we're getting the same treatment as an American with an LLC. But the limited partnership is treated the same in Canada. So we got that flow through taxation, that the partnership that is not taxed at all, it's taxed in the hands of the partners.
Mhm.
And so you're paying personal rates in Canada, which are, high. But there's no double tax. There's no, the corporation, you have the corporation's tax first. When you pull the money out, the shareholders are taxed on the dividend. Uh,
Mhm.
Now, in the US doesn't have this gross up context or concept that we have in Canada, so you do pay more tax through a corporation in the US. So the limited partnership, that's generally my advice to clients who are looking to invest in real estate. Now, if you're doing an operating company, an active business, that's different, and then we go with the corporation in that context. But if we're talking real estate, then the limited partnership is the most efficient way to do it. Now, it is a little more complex. It takes a couple entities to put it together.
Mhm.
Some people will shy away from that, like, well, maybe the cost, or the complexity for them, they don't want to, and they'll go the corporation route. But I think that's a little short-sighted because, yes, a little more investment up front will probably save you, could be tenfold down the road through tax savings.
I
Um,
have a really specific question to
and
ask because now that I have you here as the expert, so I need to ask that question. So in Canada, as far as my understanding is that the limited partnership, the reason why it's called limited partnership is because the limited liability feature that's offered with this limited partnership structure. Now, the limited partnership has limited liability. And then we have a C corp, which is what you were mentioning. If we were to set up a corporation in the U.S., then we have a corporation in the U.S. Do they have the same level of liability protection compared to each other?
yes, in slightly different ways. I mean, the corporation, the shareholders are protected. Yes, the corporate limited liability structure is this is I think is pretty basic. Everybody understands that. If you're a shareholder in a corporation, you have that
Mm-hmm.
liability protection. Okay, with a
Yep.
limited partnership, a little different. So, limited partnership, and the reason why it's a limited partnership because there is what's called a general partnership, and that just means at least two people or two entities, two persons. We'll call that because it could be an entity or a person or an individual. Two persons create a general partnership. Nobody has liability protection there, and that's just a
Mhm.
standard. That's a partnership. So limited partnership, yes, a little different. So limited partnership has two different types of partners. It has at least one general partner,
Mhm.
at least one limited partner. Okay. Now the limited partner is reason why it's limited because they have limited liability. Okay, for the business of the liability of the partnership because they have no active management. So they are more like a shareholder in a corporation. They're passive investors. They put money into the corp or in the partnership. They have no active management. Okay. The general partner is one that controls the limited partnership. So it could be if it's an individual, that person has no liability protection, but we would never set that up with an individual as the general partner. So what we set up is a special purpose entity, either a corporation or an LLC, to be
Mhm.
the general partner. and all the liability, because it has all the liability of the partnership. But it's a
Mhm,
special purpose vehicle, so it gets trapped there. It has no assets other than its ownership in the limited partnership, right? So
mhm,
so then the owner of the general partnership entity, or general partner, sorry, entity, could be the same people or person as the limited partner, but they're acting through that purpose vehicle, right? So that's how we get the liability protection. So yes, in the end of the day, you'll have the same liability protection, you know, now I got to state this too, because it may not be obvious to a lot of people here and the listeners, is that
mhm.
the US has 50 states. That's 50 jurisdictions that could have 50 different, corporate laws, limited partnership laws. So it is very state specific. So what I'm stating here is general,
Yeah.
the general nature of these structures. So
That sounded just like a lawyer's talk.
yeah.
I have to have a disclaimer. I'm not responsible for anything I say here, but that's good because I say the same thing.
Yeah, yeah. So and I'll say this, it's tricky. That's what a lot of people I run into, a lot of my clients, they set up a business, or it could be real estate or could be just an active business, like they're doing something else, and they set up in one state, but they want to venture off into do things in other states, and they learn, oh man, like they're different sovereigns really, because business laws are different from state to state, and
Mhm.
even state has its own set of tax laws, right? So
Yeah.
I would say it's not easy to do business in the US. I mean, it's not that it's not hard, it's hard, but you got to take all that into account, that it's not just I'm going to the US. It's no, it's you're going to a state, and you may go to another state, and you need to be aware of all the different state laws.
Oh, absolutely. I've been telling my husband that we are only staying with Texas for now because our first property is Texas. And
Yeah.
we want to, in our head, maybe at someday we will buy another house, but it's also going to be in Texas. Otherwise, then there is like, I don't know where he thinks he's going, but I know I deal with the accounting side. I'm like, I don't want to deal with another jurisdiction. That means another state return, another set of filing and all these, right? So
Yeah.
100% with you.
Yeah. I think if you stay in the one state, unless it makes business sense, to go somewhere else,
Yeah.
right? But I mean, the Texas, for example, is a large state, so I'm sure you can find you know properties there that suit your objectives, right? So, and it'll make
Absolutely.
your compliance, your from a legal compliance and accounting compliance much more efficient. You know,
Oh, 100%. Now, one thing that I know you also handle because you have so much experience and actually have a tax law degree, which is amazing. Um, so it is estate tax, and we all know that U.S. estate tax it could be quite substantial.
yeah,
So and as Canadian investors, how does the U.S. estate tax? Maybe you can give like a really high level overview of how U.S. estate tax work, and
yeah.
then tell us how it would impact Canadian investors and how we would be able to, what kind of strategies we have or what we need. Because I have a will in Canada. Do we need another will in the States or taxes? What do we need to do?
Yeah, that's a large topic. You opened a can of worms here. So no, I'll start with the real estate invest like well, I guess I'll start with the estate tax for the listeners, right?
Mhm,
So the estate tax is for well, for Americans, we'll say, it's if you die, all your worldwide assets are subject to the US estate tax if you're an American resident, right? But they
mhm,
do have an exemption, and this year in 25, it's $13.99 million US. So
mm,
basically, that's per person. So under that amount, if you have less than that amount of your estate or your assets on death, um, then you're not going to pay any tax. Okay, you're not as an American resident, and typically you might not even have to file a tax return at that point, an estate tax return. Now, for non-residents, it's much different. Under the U.S. tax code, it's the exemption is not 13.99 million US for non, it's $60,000, okay, for non-residents. So that means if you have as a non-resident, so Canadian resident that has US property, and we'll just use property as a general term for now, any US assets, if they're over $60,000 US in value on the date of death, the rest of those US assets above are subject to the estate tax in the US. And it can get as high as 40%, 40% of the gross value um, of
So it's
your,
not net
of,
of liability.
No, now there could be some, listen, there are deductions in that you can take when you get down, really down into nitty gritty, but we'll just start conceptually, and it's generally
Mm,
gross
okay.
value, right? It's so you have over 60 grand and then you're subject to it. Now, we do have the tax treaty, Canada and the US. So there is relief in there. So, and it's a formula. So, essentially we do get the benefit of the 13.99 million US exemption, but we have to file an estate tax return. We have to disclose our worldwide assets and values. Okay, even though they're not like assets outside the U.S. are not subject to the tax, we still have to disclose that because it's a
Mhm.
formula to get the relief. Under the treaty. So we do have to disclose that, and I get a lot of clients. I do these as well, right? I file these estate tax returns, and and clients don't. They're like, oh, why do I have to show all this? And I don't want to. It's to get the relief to get unless you want to pay you know, estate tax on everything over 60 grand, you have to file the estate
Yeah.
tax return, and so if you own, typical scenario is, Canadian owns, vacation home in Florida, right? Or state. That's
Mhm.
typical. They own it personally. That, is subject to the US estate tax. Now, and particularly a state like Florida, and again, all states are different. So when it comes to real estate laws too, so, and estate administration laws. So, but in Florida, if you own an interest in real property in Florida, you have to file this estate tax return. You need to get a tax clearance. It's called a transfer certificate,
Mhm.
and to be able to record that on title to the property to show that there's no federal tax lien. And before you can sell it. Okay.
Mm.
A lot of people don't realize that. Yeah. No, not all states are the same. Some states have differently where you don't have Florida has this because you have to file an affidavit on the death of a property owner. Anyways, you in to get those transfer certificates right now, I have clients that are waiting over 2 years still to
Oh
get
my God.
on a very basic estate, right? But it's just we keep following up, and they keep just getting these generic 90-day letters. Need another 90 days. Uh, and and I feel like it's going to get longer. So it's it's concerning, I'll say, right? I mean, now different when you own property, investment properties, right? In a structure, okay? So you own property in the US and you have it through a limited partnership or through a corporation. It still can that, if you own the shares or the partnership interest directly as an individual, right? That's still US property subject to the US estate tax. Okay. So it is still subject,
Mhm.
but you don't own the property directly, so you won't have that real issue with, oh, we got to get a tax clearance certificate to be able to transfer the property because it's owned by the entity, right? So it's
Mhm.
still the overall your structure is still subject, to the estate tax, unless it's owned by a Canadian company, right? I
Mhm.
do have clients where some structures make sense. Hey, they have a Canadian corporation that owns the U.S. corporation. Okay,
Mhm.
now that's not part of the US estate tax regime. And then or sometimes you have a Canadian corporation as the limited partner in the partnership, right?
Mhm.
Which would also own the general partner as well. So, there's so many different structures, we can get
Oh,
into.
absolutely.
There's so many
Yeah.
different, oh, this alleviates this issue, but doesn't alleviate that issue. And if we do this,
Yep.
it alleviates that, it's like, there's a lot of pieces to the puzzle.
Absolutely. So, do you think, like, for example, using the Florida client example with a vacation home in Florida, um, do you think these people would be subject to estate tax? Like, they have to file, they have to do their clearance. I call them clearance certificate because that's the Ontario term. Uh,
It's the same concept. Yeah, we can
yeah.
use that term.
So if like let's say someone who has a home in Canada for 1 million, that's worth 1 million. These days everyone owns a home for like not everyone, a
No,
lot of people
no,
owns a
but their
home.
values are high. Yes.
Yeah, the value is high. And then the US, the property could be like, depending on what you own, it could be 200,000 US all the way to like millions of dollars. Let's say it's an average of like $800,000 US. So would that person be subject to that's all the asset that person has. Would that person be subject to estate tax? Is there a concern?
Yes. Well, yeah, they'd be subject to it because they own US assets, right? They own
Mhm.
US assets, they're subject to the estate tax. And they'd have to file their estate on death would have to file an estate tax return.
Mm.
Yes.
So then, but then they would still be charged for the 40% that you mentioned earlier?
No, they're no, because if you file the estate tax return, you make an election under the tax
Ah, okay.
treaty. Um, yeah, no, they're as long as they're again, they're worldwide estate, if it's under it's again, it's a formula in the treaty,
Yep.
but it works out to being if your worldwide estate is under the exemption amount, again, in US dollars too, right? So right now that could be like 20 million more US
Yeah.
Canadian, right? I mean, it's
Yes,
just
yes.
the exchange rate. So
Yeah.
it's no, so that case, you're in that case, you just said they wouldn't owe estate tax if they file the tax return and file it
Mm,
timely. It's due 9 months after death. You can get an
mhm,
extension of 6 months if you file the
mhm,
extension before the 9 months is over, right? So as long as you file the state tax return timely,
mhm,
then they won't owe tax, right? They
mm.
need that tax
Yeah,
clearance certificate, right? That transfer
yeah,
certificate back.
yeah,
So,
yeah.
so it's like,
Awesome.
yes, it's subject, but you won't pay, right?
You
Unless
yeah,
your overall worldwide estate is exceeds the exemption amount at
yeah.
the time. And then you will, and it's not on the full amount. It's again, it's a formula. So, if it's, you're at say $15 million US worldwide, estate,
Mm,
you're not going to owe 40% on the full value of your US property. It's a formula. So it's a fraction
mm,
of that. So
yeah. We all aspire to have that much in our portfolio for sure. We'll deal
if
with the
I, yeah,
consequences.
if I have that problem, I'll be okay with that.
Exactly, exactly. But practically speaking, we may not have the estate taxes that payable, but we still need to file that estate tax return, right? And the other thing is that my understanding is that very much like Ontario, you need to have a will. Otherwise, nothing. It's very stalled. It's even longer process than a regular um, property that has a will that come with it if when someone pass away, right?
Yep. Yeah, so if you own real estate in the US, yes, you
Yes.
you wanna and even other assets too, financial accounts, I got a lot of clients
Yep.
have investments in the US, but if we're talking about real estate, if you own real estate personally in the US, yes, you should at least have US, again, when I say US, I mean, it's gonna be a specific state law, but I'll use generally the term, a US will, a US power of attorney, and since you're gonna be spending time there, if you are, get a US healthcare power of attorney too, and these are
Mhm.
documents. It's again, everybody's situation different, but you can name the same people you might have in your Ontario documents or your other provincial documents, but these documents are based on that state law where the property's located, right? So yeah, so you would want that because the will is going to be more efficient to have a state specific will.
Mm.
The power of attorney is the most important one though. Like if you don't, because if you don't have a U.S. will when you pass away, we can use your Ontario will. Like there's ways. It's might create some challenges, but we can use it, right? So that's.
Mhm.
But with the power of attorney, if you don't have a state power of attorney document, someone in the state, like a buyer, typically that's gonna be the case. It could be a husband and wife own property in Florida, and one of the spouses loses capacity. Okay,
Mhm.
has a stroke, and they're like, "Oh, we've got to sell. No, we're not going to use it. Let's sell the property." Well, both spouses have to sign off on the sale, right? So if the other spouse didn't have a power of attorney document naming the other spouse as the agent under the state law, you have to go to probate court and get appointed guardian, right? So there's a long procedure. They won't accept the Ontario power of attorney document.
Mm.
So important to have the
Yeah.
state specific on power of attorney at minimum, right? There's other documents you should have, but that's the most important one I find.
Yeah. I mean, this I think it comes to it's applicable to a lot of people, not just specifically for investors that invest in the US.
Oh, yeah.
Like locally, if you live in Ontario in Canada, you should have a will. And a lot of people
Yes.
still don't have a will, right?
Correct.
Um,
Yes. And yes. Yes. If you don't have a will now, go get a will. Basically, yes. A will and a power of attorney. We call those like your primary ones, your domicile. Like if you live in
mm,
Ontario, right? You make sure you have, your local documents. And then if you have property in other states, other countries, and it could be beyond you, it doesn't matter. Go to those countries, those states, and make sure you have the appropriate documents to cover those your property in those states.
Amazing.
Yeah.
Thank you. I appreciate it. Now, in the unfortunate or slash fortunate event, depending on how you look at it, if my husband does venture outside of Texas, does that mean um, if you have properties in multiple jurisdictions, does that mean you would have to set up wills in every single state that you own properties in?
No, you could get by with just one. So like
Oh, awesome.
yes. I mean, generally speaking, I guess we did again, every state's different. We don't want to double check. And I only deal with wills, in the states I'm licensed in, which are the
Mm,
big ones for me, at least in Ontario, Michigan, Florida, Arizona,
mhm,
California. I mean, but I mean, like you want to typically I say no, one will be fine. You can use because in the US, you're going to just file the will initially, and then you're going
mm,
to go afterwards. And if you own property in other states personally, I just
mm,
find that's rare though, anyways, because most people you have property in multiple states. Typically, you have them in a structure. They're not
mm.
they're not
Yeah,
vacation homes.
yeah.
I don't really. Few clients I guess that have multiple vacation homes in multiple states. I don't haven't tapped that market yet. um,
That's a super high net
but
worth problem that we have to
exactly
have.
right,
Yeah.
yes, and so if yeah, but if for investment purposes, I mean, I would have those in a structure, and then you don't have to worry about generally worry about the wills.
Mm, okay, awesome. Now I've been taking up a lot of time. I'm asking specific questions, like a lot of specific questions, which I think it will benefit all the people who are investing or interested in investing in the US. Now, my one last question, which came up, I guess it became somewhat popular in the last little while, especially post COVID or during COVID time as well,
Yeah.
is how can a Canadian real estate investor qualify to get the US investor visa?
Mm.
And can they do that by just purchasing a rental property? How can they do that in general? Like, I know this is big topic, but
Well, it's
this is the last question, I promise. Other than how can we contact you?
yeah, it's okay, yes. I mean, yeah, it's possible, absolutely, right, to get an E2, you're referring to an E2 investor visa, with real estate. So it's basically what it is. It's you have to, you know, um, invest, you know, substantial funds for the business. Okay, you have to make a
Mm,
substantial investment for the business, and that's what does that mean? Okay, well, it means first it has to be a business, right? Well,
yep.
what's a business? I would say one rental property is not a business, right?
Mm,
Like one, I'm talking single family home, that's not a business. So it has to be more than one property. We'll say that. How many? I mean, that becomes subjective at that point, right? how how you how you look at that. The more properties, the better. If you have multi-unit, that's even better. If you have commercial, like a plaza or something, even better. But it has to be a business first, right? So it has to, and theoretically, it could grow. You could be, oh, I'm going to start with this, but my plan is to do more than that, right? So that would be
mhm,
part of the presentation in the application, and like in the business plan, we have this, we want to grow to this, and this is our business, right? Okay, well, what's substantial investment for that? Again, it's subjective. There's no you have to invest X dollars. They don't, so it is very objective. Um, I'd say for a real estate venture, you have to invest more, generally speaking,
mm,
than if you were doing a restaurant, for example, right? So
mm,
where a restaurant, yeah, may take, $100,000 to get off the ground. Okay. So that $100,000 is probably going to be substantial for that business, right? So that's
mhm,
when you come to real estate, it's like, well, is $100,000, to buy the substantial? Probably not. I even venture to guess it's not. I wouldn't.
mhm,
So it's nearly impossible to say. I do meet with a lot of people on this very topic, right? So it's just dependent on what you're going to do and how much you want to invest. If you're just doing rental properties, right? But
mhm.
there's other real estate activities you can do too, right? I mean, I know people who maybe flip houses and maybe want to get into
Wholesaling.
property
Yeah.
management,
Yeah.
wholesaling, they do other things. So you're
Mhm.
not just buying property at that point, you're maybe investing funds in other parts of the business, right? Oh, we need an office, and that's important, obviously, to have for any business.
Yeah.
So I mean, there is a lot that goes into that. So I mean,
Yeah.
it's hard to say this is what you should do, but it's possible to get an E2 visa for real estate if depending on the business, right? Depending on what you're going to be doing and how many
Mm,
properties and how much you're investing. Um, so like I get them forever. I get them for people doing like, just rentals, but they have, several, or they got a large multi-unit family complex, or I got ones that do a commercial plaza, right? And then whatever other activities they're doing, ancillary to the real estate, like I said, property management for others and, wholesaling and whatnot.
Wow, that's a lot of information.
I mean,
Uh,
a lot
I'm
of them
still
may
trying
be, I
to.
know, not really settling on anything, but happy to talk to anybody.
Yeah, absolutely. So if someone have questions about any of the topic that we talk about today, and we cover a lot, how
Right.
do they contact you?
I think the best and easiest way to go to my website,
Mm,
ingenuitycouncil.com. There's a
hmm
contact form right in there. It'll come right
hmm
to me. That's the best way. And then we'll set up, a courtesy consultation.
Awesome.
Yeah.
That's fantastic. Well, thank you so much, Michael. You've provided so much value to our audience. Really, really appreciate it.
Well, I appreciate the opportunity. Really do. Appreciate the opportunity coming on here, asking me these questions. Hopefully I spoke slow enough for everybody. I do have a tendency to talk fast, so I apologize to everybody.
Don't
Put me on
worry,
slow,
because
put
I
me
speak
on.
really fast.
Oh, okay. Put this
Yeah.
on 0.75 speed, slow it down.
Awesome. Thank you so much. Appreciate it.
Thanks, Cherry. Appreciate it. You have a good day.